Mark Lichtenfeld, if investors are looking for dividend stocks, one place where you suggest finding them is Crown Castle shares, pays 4.1% dividend, stock's down around 1.5% this year. So why Crown Castle as opposed to American Tower or SBA? Why is this the best tower company?
Well, a couple of reasons. I love their balance sheet. And the other reason is they generate a ton of cash flow, free cash flow, and don't pay a whole lot of it out in dividends, even though they have an attractive yield. So their payout ratio is very, very low. And they're a new dividend payer. They've only been paying dividends since 2014. They raised it in 2015. And because they have so much cushion between what they're paying shareholders and what they're bringing in for free cash flow, I think they can raise that dividend significantly over the coming years.
And you're also a fan of Mattel for those seeking dividends, pays a nice 6.7% dividend. That said, the stock's down around 30% so far this year. Tell me, how big are the problems in Barbie land?
They are significant. I mean, this is a turnaround story. This is one you have to be patient with. But they have brought in an executive named Richard Dixon. He's now the president of the company. He's known as Mr. Barbie because he's turned around the Barbie brand before several years ago, left to go run another company, and now he's back. So Mattel has its work cut out for it. But if you can be patient, and you can collect that nearly 7% dividend. And I should mention, even though they have all these problems, they still generate profit and they still generate enough free cash flow to pay that dividend. And they've been saying repeatedly over the last few months that that dividend is sacrosanct. That is one of their top priorities, is to continue to pay that dividend. And
another stock you like is New York Community Bank Corp. This stock is doing much better. It's up around 12% so far this year. Pays a nice dividend, 5.5%. But what happens when the Fed finally raises rates? That would probably be a good thing for NYCB, right?
Absolutely. Higher interest rates probably means more net interest income for NYCB and the other banks. The really interesting story here is that they have about $48.5 billion in assets, and $50 billion is that limit, which is considered too big to fail. So they're managing their business to stay right under that $50 billion mark until that limit is lifted. If it is lifted, and there's been a little bit of talk in Congress about that, then this company could grow very, very significantly. If it's not lifted, you're still getting paid nearly 6% yield for a very, very well-run bank. And this is a bank that had virtually no problems during the crisis.
All right, and then finally, New Mountain Finance. Now, this is a BDC, a business development company. They pay 9.5% yield, but it's down around 10% so far this year. Why do you like a BDC? It's a very easy place to find yield.
Yeah, and they just did an equity offering. That's one of the reasons the stock is down recently. What they do is they lend money to businesses that can't get a loan from the bank. And as a result, those interest rates are a little bit higher than they could get from a bank. So they're typically lending out money at double-digit yields. But they're not investing in startups. They're not lending money to startups. These are companies that are cash flow positive, that are often in niche businesses with high barriers to entry. So they're not just throwing money around to anybody who needs it. They're very careful about who they lend the money to, and you get that 10% yield. I mean, it's tough to beat that for a relatively safe BDC.
All right. Well, thanks a lot, Mark.
My pleasure. Thanks for having me.
And thank you for watching The Street.